So Africa is looking for that portfolio of finance that will help the continent ramp up on its huge infrastructure development. So FSD Africa and its partners got together this week to discuss how pension funds and the capital markets could be a veritable source of such blended finance. So let's grab a bit from this panel that focus on what was discussed on Wednesday.
The problem we have all identified is the fact that there's a lot of exposure to government securities, and so diversification is key. Inflation is a problem. It is also important to have inflation-edged, to have exposure to inflation-edged products. So risk is important here to be able to achieve the quality of returns that we want. I think that some other things that we've observed, from products that have been thrown into the market have been the return prospects. The problem we have all identified is the fact that there's a lot of exposure to government securities, and so diversification is key. Inflation is a problem. It is also important to have inflation-edged, to have exposure to inflation-edged products. So risk is important here to be able to achieve the quality of returns that we want. I think that some other things that we've observed, from products that have been thrown into the market have been the return prospects, risk return prospects, so to speak. Sometimes many of these products are sold on the back of developmental benefits, which are great. And as PFAs, we appreciate the developmental benefits behind those products. Social benefits, ESG benefits, and a few other things. But the truth is, as PFAs, we are ranked on producing competitive returns. I'm sure for many of us that have RSA funds with different PFAs, we see the rankings every now and then on a monthly basis. Even if we say we need to de-emphasize the monthly competitiveness associated with returns reporting, even on a 3 to 5 year basis, you want to look at your performance, and see how much contribution these alternative asset classes have brought into the table. And so that then takes us to the quality of returns that these assets actually produce. Are they competitive enough? I think that in the last maybe 7 to 8 years, I think the level of growth in the economy itself, is reflective of the kind of real return that we have seen on these products. In the last years, I'm sure on average, growth rate has been just around 2 to 3%, about 2%, right? If the aim is to grow return, the aim is to achieve real return on funds that we manage as against just fixed income products that we have exposure to, then those are things that we need to look out for too. As PFAs, we have a fiduciary responsibility towards contributors. In a time like this where inflation is at high levels, 22%, contributors also want to have competitive returns to back up, to cover up, for the high inflation, so that at the end of the day, the real value of their contributions are kept intact, And so those are some of the challenges that PFAs have, that inform the need to balance between developmental objectives and return prospects.
2019 was probably a light bulb moment for many pension funds, because for the last 10 years, as Chinua said, pension assets really grew within the last decade. From 6 trillion today, we're about 16 trillion. So it's really, in the last 10 years, we've seen a lot of growth. And for a lot of that time, interest rates were higher. Central bank used to always keep interest rates, generally high levels. You took it for granted that interest rates would always be higher. Until 2019, Central bank started to play with low interest rates. And pretty much since then, we've struggled to go back there. And so for everyone, suddenly you have to wake up to the realization that your biggest asset class is no longer going to be giving you a yield that makes sense. So you have to sort of start looking for other alternatives and options. And so things like infrastructure bonds, infrastructure debt funds, private equity, all of these things started coming onto the table. And I think for us, in assessing these projects, aside the lesson about investor education, I would say governance is something that we always found to be very key. Because, I mean, there are some experiences you've had that haven't gone quite well. And what you tend to find is that at the heart of it really is you couldn't quite figure out the governance or work out the governance framework that sort of covered any scenarios that you did sort of anticipate. I mean, there's a bond that most people know. I mean, there was a time the bond sort of missed payments, and for a long time we were in the limbo, and it just dawned on us that the structure that we went into was not a structure that allowed for us to be able to provide feedback to the trustees and to the various parties that things were going on. Eventually things sorted itself out, but I think governance was one lesson we took out, that look, whatever you're doing, always try and have a very strong governance framework. The second thing, and beyond governance, also alignment. Alignment is very key as well, because particularly for the infrastructure funds that we work with, these are funds that typically just look for infrastructure projects, invest in these projects, and they earn a fee, right? And they also give you a promise. So the way I would like to look at it is that although most infrastructure funds are debt funds, it's not like a bond. With a bond, I know that for sure, if you tell me you're going to pay me 10%, it's 10%, come rain, come shine. But with an infrastructure fund, it's a promise. It's a promise that we'll do our best to give you something.
But the major issue was valuation. How do you value it and what exchange rate do you use? So at that time, we had the pilot market rate and the official. So the seller wanted to sell at the pilot market rate. The sponsor, what's called the buyers on the other side. So we had an anchor investor in the vehicle, wanted to buy at the official market rate. We sat there for longer than 4 months. We didn't close that deal because every single day, the pilot kept moving away from the official up until now we've not closed the deal. So I'm talking about real life experience where you're looking to take an issuer to the market with an anchor investor looking to anchor that deal, but you couldn't make a decision as to what the value, what's the price of the pool of receivables, because the receivables are in USD. And we didn't make that decision in 4 months. And even after we went to credit rating and got a decent credit rating for the deal, we still couldn't close it because we couldn't make a decision as to how to value that. And then you now come into a situation where the major new ones that are coming to the market is the removal of subsidy. So with subsidy removal, what we've got is we've got a lot of inflationary pressures, and we've got a situation where all of that is basically pushing, pension funds are looking for real returns. And I just came out of the market with a transaction where pension funds are pushing, they wanted us to go above, as much as possible, above 15% coupon rate on the AAA issuer, by the way. And who was issuing somewhere around the five-year tenor. And so for the benchmark for that issuer at the time when we went to the market was 13.9. So if you were to give them 15% coupon on that, so you'd be pushing the risk premium on the AAA to more than 120 bips. And for us, it didn't make any sense. But I knew where we were coming from because of the inflationary pressure. And when you not consider the fact that before now, the last time I took a couple AAA rated issuers to the market, we often had in excess of 120, 150% over subscription, because then there was a single market, a single price, in the sense that corporate instruments were tax exempt. Today, corporate instruments are no longer tax exempt. So what that simply means for corporate issuers is that you are dealing with two prices, because whilst the commercial bankers and the asset managers would be looking at incorporating the cost of with the tax implication, pension funds, they don't look at that. So I saw that in real time in this last experience I just had, where typical commercial bankers usually wanted to buy AAA instruments. And I took a AAA to them, and the pricing didn't make any sense to them because of the tax implication. While for the pension fund, the pricing made sense, but they wanted to push me above 15% coupon. And then, so again, that's the sort of thing we've seen in this time where subsidy, inflationary pressure, but you're not going to talk about the exchange rate challenges and what we think now. Now with the new sort of like what I call relative harmonization of the exchange rate, what we've seen is that a lot more persons are now beginning to be confident that we can now start seeing FPIs come back.
So I think in the context of the Africa Finance Corporation, our mandate is to really close down the infrastructure gap that will enable industrialization. We cannot industrialize without power, transport, logistics, and all the connection systems from ITC to hardcore. So last year, the PIC, which is the largest pension fund in South Africa, put in 100 million equity stake in the AFC at the parent level. In terms of specific, I think we are working with the PFAs in Nigeria